RSI, or a relative strength index, was introduced by Mr. Wilder in the 1978. It is an oscillator indicator which is measuring the magnitude of recent price action changes to catch the overbought and oversold conditions. Hello guys, my name is Jordan, and in this video we are going to talk about RSI and 5 of the most frequently ways to use the RSI indicator besides the ones introduced in the book. So, starting with the very first one. Now, the very first thing, according to the book at least, and to the author, is the idea of catching overbought and oversold conditions. We should mention that the author suggests anytime the price drops below 30 or jumps above 70, we are in overbought, meaning here conditions, or oversold, meaning here. Now you will notice that on my chart I'm using 75 and 25, which is a bit more extended as we're dealing with Forex, and I just find it for myself more useful to use these two levels. So this kind of approach is pretty straightforward. We're basically waiting for the price to cross the specific level, and then we're looking for the price to start moving in the opposite direction. The thing here is, with overbought and oversold conditions, the first thing we need to mention is that it works best inside ranging conditions. If we're in a very strong situation, very strong momentum, and we have a specific direction with strong momentum behind it, overbought and oversold conditions are not going to work as we wish they would. Okay? And we can see that very clearly in indicators like stochastic, for example. So just remember that when you're using it in overbought and oversold conditions, always check the overall price action, and remember that this kind of idea works best when we're talking about ranges. The second approach that we can be using RSI for is chart formations. Now let's start from here. The idea is that sometimes we will be able to see patterns that we're not able to identify on the chart, on the price action. We will be able to identify them on the RSI indicator. I personally don't use it this way. The way I do it is I draw the patterns and I use it for breakout confirmations, which would mean, let's say this is a pattern that I'm following. I can find similar pattern on the RSI indicator right here. I draw the lines, and once I get the breakout on the chart, meaning the price action, I would also like to get the breakout in RSI. So if I zoom in a bit here, you'll see what we're talking about. This is the first attempt for the price to go ahead and break below, okay, with the spike. You'll notice that in this very specific moment, RSI didn't really cross the line that we can draw here, the trend line. The next one though, we can already see RSI is much lower, and it provided us with the breakout. So this is a way how we can confirm breakouts when it comes to trend lines, when it comes to different chart patterns. Here is another such example. You can see that RSI reached towards the top, which means overbought conditions, and right here on this big bar we got the breakout on the RSI trend line. Okay, the breakout, the same trend line breakout, happened on the chart much later, but we already got the confirmation here that the price should be moving lower, at least based on this kind of confirmation, once again using RSI. I have one more example here on the next trend line, and here the situation is almost identical, and by situation I mean price and RSI. This is the previous bar. You can see that we did not get the breakout, okay, and here things are happening simultaneously. This is probably the best way we should be looking at RSI breakouts and confirming the breakout when they happen simultaneously in the same bar. So breakout here as well. Okay, then we do have the next idea, which is basically a failure to create new lows or new highs. That could be also referred to as false breaks. So what is this idea all about? We can see bearish momentum developing. We can see RSI going below the extreme point, which means oversold conditions. And now we can expect for the price to push up if, of course, other factors are in place. This is where we see the first attempt of RSI to start pushing higher right here. Okay, and that push higher is formed by these two candles, the two green bars we can see right there. Then RSI forms something that reminds a top right here. We can see this kind of formation, and then the price pushes lower on the next red bar. So this is where we can say, okay, we are in oversold conditions. It's attempting to move higher. It's giving pullback. Now the thing is whether we're going to break below the previous low, continue with the momentum, or we're going to break above the newly formed high, which in our case is right here. And this is how we can identify the false break. So we got the push lower on the red bar right here, and then on the next bar marked by the arrow, we can see the green bar is breaking above these two highs, okay, and RSI is definitely pushing higher as well, confirming that we should be most likely going to see bullish run afterwards. Pretty much same idea would be applied to the sells. Okay, let's take for example here, we're not exactly in an overbought condition. Let me try to find one that would explain this idea precisely. We just need to find overbought conditions here. So we see pretty much same idea, but vice versa. Price is pushing above the 75 level, and that's on this green bar. Then we see the price moving lower right here, creating this low, okay, with the angle. Then price pushing higher a bit much, but we know that if we break below the low of this specific candle here on RSI, of course, later on we can expect for the price to push lower. So in terms of RSI, you can see that the price started the push lower with the big bar. We got the breakout on price, and we got the breakout on the indicator, and then you have this fantastic move following afterwards. So that would be idea number 3. Then let's go to idea number 4, which is basically using RSI as support and resistance. It's very interesting to use it this way because we can see very differently how price action forms and the bars forming on the chart compared to RSI. This same period, guys, look at it. We have something that tries to create bullish push, creating higher highs, higher lows, but on the same time, RSI is not moving, it's not going anywhere. And when we look back, we can see that this zone here becomes our RSI supportive zone, and we can mark it like this. This is the very bottom, the spikes on the low covered. And then comes the interesting part. Look where we are breaking below this zone, right here on this bar. And this is the same bar on the price. So if we would be measuring the horizontal level as we have it here, that breakout should be only in that place. If we measure it with trend line, that breakout would be again much lower, missing that entire move. So instead we can use RSI, and RSI is telling us, okay, it's most likely time for bearish moves, we're breaking. And again, here we can be using the pretty much same idea as we showed before that. It pushes lower, gives us the pullback. If it goes and breaks that low, okay, we can be looking for the sells. And that low, in our case, was created by this green bar, which pushed higher. So that means break below it should be opening the doors for the sells. And that happened on the very next bar right here. We got the breakout, as you can see. Okay, that low was broken here and here as well. So using RSI as support or resistance could be again absolutely fantastic, and it gives you totally different perspective on the market. And now number 5, which is probably my favorite one, because I am a divergence trader and I love divergences, and confirming divergence with RSI also one of my favorite styles of trading. So what is divergence basically, guys? Divergence is the moment and the place when indicator and price action are showing you opposite measurement. On price, in this case, we can see price is creating higher highs. On the indicator, at the same time, we are seeing the indicator is creating lower highs. And this is what we call bearish divergence. Okay, that shows us weakness in the buyers, and we are likely to see bearish pullbacks or bearish reversals once that appears. Then we have the opposite scenario, which is the bullish divergence. It does absolutely the same thing, but in the opposite direction. So you have bearish trend, low number 1, low number 2, and on the price we can see lower lows being created. Then on the indicator we can see higher lows being created, which means the momentum is not there. Even though price is pushing lower, there is no momentum behind that push lower. Okay, so catching divergences with RSI is very profitable. Of course, you need to know a bit more about divergences. You can go ahead and check out the Divergence University at divergenceuniversity.com. Fantastic course on divergences, but RSI used for this purpose could be absolute killer as well. So that would be all. I would really love to hear your opinion on how you use RSI, guys. Any different than this, or if you're using it this way, do you have any comments on the confirmations? Okay, please leave your comment below. I would be happy to see what other traders are doing. And of course, don't forget to join our Telegram, free Telegram channel, where me and Vladimir Rybakov are sharing on daily basis educational materials and different promotions and offers and trading setups and much more. Thank you and have a wonderful day.